Good morning. Welcome to Stock Market Today. It's Tuesday, September 3rd, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email so you can follow along with this show, as well as get daily stock ideas for you to consider in your inbox every trading day before the market opens. So I hope that everybody had a great long weekend. Let's get back at it. The start of September. So U.S. equities were mostly higher in Friday's trading and broke a 4-week losing streak. Materials and industrials led, while the consumer sectors, staples, and discretionary lagged. Treasuries were stronger across the curve. The 30-year yield still below 2%, and the 210 spread is near zero. Dollar is weaker versus the yen, but the euro hit its lowest level since 2017. Gold finished down 50 basis points, and WTI crude got hit hard, down 2.8%. So your outperforming sectors: materials, industrials, fins, and healthcare. Underperformers: discretionary, staples, comm services, and tech, though I will note tech did finish higher on the day. As we get to the desk to start the new month, S&P futures are down 80 basis points after that rally last week. Treasuries are stronger across the curve. 10-year yield is back below 1.5%. Dollar is lagging on the yen cross, but stronger against the euro. Gold is up 70 basis points, a little bit of a defensive bid, and WTI crude is adding to the downside, down another 2% to get things going to start the week. So for the S&P 500, we are testing the top of the August range. And as we said, futures are pointed lower here this morning. Support is in the 2,800 to 2,850 zone. Resistance in the area between 2,950 and psychologically important round number of 3,000. RSI is showing signs of life, but it does remain in bearish ranges. This is something we've been talking about for a while, how the rallies have not been able to produce an RSI that gets out of this bearish zone, right? Notice we've become oversold a couple of times recently, and of late have not been able to break much above the 50 mark. We did close at 51.92 on Friday, but still, for all intents and purposes, in bearish ranges. Chaikin money flow, however, is bullish and did start to tick up towards the end of last week. So the indicators are mixed. The market is still in a range. We've talked about seasonality. We showed it on Friday. September tends to be a weak month on average before giving way to strength in the fourth quarter. So I still think it makes sense to be nimble here, right? Towards the top of the range, we want to be identifying good stocks and leading industry groups and then looking for opportunities. But until we break much above this range, still mostly a lot of the same from a range-bound market perspective. Taking a look at our market in a minute. What are we writing about in our note today? It is Tuesday after the 3-day holiday weekend, so we'll be looking at our relative trends across sectors. But first, S&P 500 breaks a 4-week losing streak, but does remain in that range. I think that's really a big story. Technology and bond proxies remain leadership at the sector level, while bearish relative trends continue to hold for energy and financials. Transportation stocks remain underperformers, and as we said, futures do point to a lower open here today. So after breaking a 4-week losing streak, let's take a look at the power bars for the major markets. The Dow, 2 bulls to 8 bears, so still skewed towards the bearish side. S&P, same story, skewed towards the bearish side, 78 to 97, bulls to bears. NASDAQ underperformed on Friday, skewed to the bearish side, 19 to 23, bulls to bears. Small caps still skewed to the bullish side, despite underperforming on Friday. 393 bullish or very bullish stocks, 386 bearish or very bearish stocks. Bonds rallied, sending yields lower. According to the Chaikin Power Bar, small cap stocks are somewhat more bullish than large cap stocks, and the major markets across the board are mixed. Our stock of the day: Rambus Inc., one of the semiconductor stocks. Now, one of the things that we've been highlighting recently within technology is how software has started to waver in its relative performance, while semiconductors have kind of picked up the baton a little bit. And Rambus closed at 1254 on Friday, up nearly 3%, has a very bullish power gauge rating due to very strong price volume activity, very positive expert activity, attractive financial metrics, and strong earnings performance. When we take the 20 factors, 5 in each of these 4 categories, we come out with our very bullish rating, very bullish stock, strong trend, strong industry group, right? Outperforming the market. So market and model are in agreement. Now, Never hit oversold here, which is kind of encouraging from a momentum standpoint, but money flow does bother me a bit as the stock consolidates after making a high late July and early August. So for me, I think if you want to be a little bit more on the aggressive side, the stock looks okay. If you want to be a little bit more conservative, given the choppy nature of the market, I can't argue with waiting for a little bit of a better money flow reading. But Rambus looks interesting as it consolidates here. Long-term trend line has acted as support and kept the stock in its range within an uptrend. For me, I think it makes sense to get more aggressive on a break through 13 to the upside. But if you want to kind of look for opportunities here, not high conviction, but I can't argue with a bullish call on the stock. Our sector tracker now, looking at the movement of the major sectors. Over the last 5 days, they've all been positive. Industrials had a nice rebound yesterday as there was a bit of a de-escalation in the headlines around trade. Communication up 3.5%. Materials starting to re-exert some relative strength last week. Financials, as the downtrend in rates kind of stabilized a bit last week, the financials caught a bid. Tech, energy, and discretionary, middle of the road. Healthcare, staples, Utes, and REITs towards the bottom of the list. It was definitely a risk-on week last week, so these defensive sectors did underperform. But still, again, all sectors positive on the week. Our industry in focus, the NYSE Tech Services Group, which over the past 6 months has been a slight outperformer. Let's call it really an inline performer. Outperformed the S&P 500 by 58 basis points. It does have a neutral power bar ratio, 8 bullish or very bullish stocks for 8 bearish or very bearish stocks, which earns it a rank of number 11 of 21 subsectors, and it's moved down 1 slot over the past week. So with a group like this, where relative performance is middling, stock selection does become important, and in particular, you really want to avoid the bearish stocks like Tesla, Square, and Netflix, all with very bearish Chaikin power gauge ratings. And if we take a look at this industry itself, the XNTK is the fund here that represents that industry. We can see 8 to 8 bullish ETF rating, but below the long-term trend line earns it a weak trend. You can see the middling performance here, right? Just an inline performer over the past 6 months, closer to overbought than to oversold with bearish Chaikin money flow. So really, again, selection becomes important here. I'm not saying you don't just dismiss the group, but you really want to skew your long ideas to the bullish and very bullish stocks that are outperforming the market when those stocks are oversold. The group itself, really just a bag of mixed signals, and that's fine, right? Stock selection becomes important there. You want to avoid those bearish stocks and look to the bullish stocks for your ideas within the portfolio. Taking a look at what's trending now. Friday's S&P 500 movers and shakers, our gainers and losers. Western Digital didn't see any real news to drive the stock higher by nearly 4% on Friday, but I will note that it did catch an upgrade today. So we'll see if that stock can follow through. Dollar Tree, a little bit of a rebound after some weak earnings, up nearly 4%. Campbell Soup, CPB rather, part of that group of stocks within consumer staples that have been doing well, up nearly 4% following their earnings announcement win, up 3%, 3.6% as trade tensions de-escalate. But I'll note that in the pre-market today, it is giving some back. And DD, I did not see any real news to drive that stock higher by 3.28%. On the loser side of the board, Ulta loses nearly 30% in Friday's trading following their earnings announcement. Alexion down 10% as one of their patents is being reviewed. Cooper, COO, down 5.73% following their earnings announcement. And this just speaks to me to why it's important to have a disciplined process. Cooper was a name that we'd been highlighting in our market survival guide. It had been acting well for a while. We'd been moving our stop level up. Remember, disciplined risk management. We'd been moving our stop level up, and the stop was breached. So we said this is no longer qualifies as a bullish idea. Come out on Friday, their earnings announcement sends the stock lower by 5.75%. MRO down with oil to the tune of nearly 3%. And Estee Lauder is an Ulta derivative, down 2.75% or 2.76%. on the day, on the heels of that weak earnings announcement from Ulta, which again, as we said, lost 30%. So let's take a look at what we're seeing across some of the sectors as we do our relative strength work. The financials remain under pressure on a relative basis. We're looking at the financial select sector ETF relative to the S&P 500, and you can see a clear downtrend below the declining 200-day moving average, largely a function of rates as the banks just can't get going to the upside. And it's frustrating because the fundamentals look okay. If we look at the power bar ratio for financials, it's consistently near the top of the list. But remember, two legs to the stool: power gauge rating and relative strength. And right now for financials, the relative strength just is not there, right? And you can see that this trend has some momentum behind it as the overbought, oversold indicator cannot get to an overbought reading. And this speaks to understanding the characteristics of the indicators that you use, because if you've been waiting for an overbought reading to underweight the financials, you never would have had a chance. This hasn't been overbought in more than a year. Nearly 2 years, really, since it's been overbought. So momentum confirming, and you can see now on an absolute basis, the financials have broken this uptrend line off the December 2018 low, got into a bit of a consolidation here. So the group continues to struggle as rates continue to decline. But rates are keeping a bid to the bond proxies. We've looked at utilities. Now let's take a look at real estate. Here's XLRE relative to the SPY, and you can see broken out of this consolidation and holding the breakout level, remaining above the rising 200-day moving average. Again, we talked about the indicator. Look at the indicator and the personality here. Notice that on the pullback does not become oversold. So if you were waiting for an oversold condition to get into or overweight real estate, you really haven't had much of a chance, right? Indicator is now routinely becoming overbought, holding within bullish ranges. So that tells me that there is momentum behind this trend higher in real estate on a relative basis. Utilities look much the same. Again, same dynamic at play, lower rates helping the bond proxies. And you can see here a nice steady uptrend for XLRE, trading up here near 52-week highs on an absolute basis. So, real estate continues to be an area of the market where I think it makes sense to go looking for long ideas, especially if you are of the view, as we are, that rates have room to move lower. Technology, on the other hand, is holding its relative breakout. XLK relative to the SPY has been leadership above a rising 200-day moving average, gone into a bit of a consolidation here, but holding above the breakout level. Now, a couple weeks ago, we were talking about the potential for a false breakout here. That's been negated as the group now holds above that breakout level. Notice that on pullbacks, the RSI is holding within bullish ranges. So some momentum confirmation to the relative trend that we're seeing here. And on an absolute basis, XLK continues to hold the uptrend line off of those late 2018, early 2019 lows. I would expect technology to continue to outperform. But as we said, one of the shifts that we've noticed within the technology sector is that the performance is being driven more so of late by the semiconductors and less so of late by the software groups that were really driving the bus for much of the past 12 months. So always important to understand the dynamics at play underneath the surface. That's why we take this top-down approach. We look at the market, we look at the sectors, and then we drill down to the industry level to really find the areas of that are leading the market and look for the best opportunities within those leading areas of the market. One of the areas that is not leading is transports. Now, industrials have struggled of late with the trade tensions, and transports have been an underperforming group. You can see here choppy trading, but below the 200-day moving average, which is declining. RSI, this is XTN absolute, by the way. RSI remains in bearish ranges here, has not been able to rally above 50 with the recent rally in the stocks. And on a relative basis, XTN just in a clear downtrend if we look at it relative to the S&P 500. So an area of the market that we continue to want to avoid or potentially look for bearish opportunities in very bearish and bearish stocks within that group. So that's going to wrap it up for today. If you like what you're hearing here, help us spread the word. Share our link on social media, Stock Market Today. I will be back here tomorrow. Hope everybody has a great day and a great start to September. We'll see you tomorrow, everyone.